Good afternoon, everyone. So it's the end of the month again, and welcome to our monthly market updates for busy people, July edition, where we'll help you to get up to date with the global stock market before you can finish your lunch. I'm Chye, a financial market analyst and coach at Beyond Insights, and this is your express session to get up to date with the stock market. Since we are doing this over the lunchtime, I will start the timer when we start, and I'll keep it to 20 minutes. And for this session, we'll cover the market highlights, major stock market indices performance, and the upcoming potential opportunities and also risks out there. So are you ready? You may type me in the comment section. So are you ready for the market update? All right, so let me start the timer first. Okay, let's start. So just an important note before we proceed. Whatever we share here today is based on the latest data and also facts. If there is further development, things may change. And we want to make sure that you know we are not a licensed investment advisor and we do not manage customers' funds. We are an educational institution. So our purpose here is to educate people so that you can make your own decisions and be your own investment manager. That way, you have a better control over your own decision and hence able to get better results. If you are looking for stock tips, this is for you. All information we share here are meant for educational purposes only and must not be taken as a recommendation to buy or sell. So let's start. Let's start with the market highlights. So for the month of July, the Nasdaq 100, which track the top 100 tech stocks, and also the S&P 500, which track the top 500 companies listed in the United States, are continuing their uptrend after year-to-date gains of around 43% for the Nasdaq 100 and 18% for S&P 500. So any one of you here managed to execute a good trade or go into a good investment over the past few months or over the July month? You may type me in the chat as well. Any one of you managed to get any good investments or trade or enter any good position or any tickers you would like to share here that you have managed to catch during the past months? You may type in the comment section. Yeah, very good. I see some of you managed to go into good position, get into a good investment or trades. And over the past month, inflation continues to be trending down. So we can see that during the month of July, the CPI data in the United States is coming down. It's at 3% now for the inflation. However, in the Europe and UK region, they still remain at elevated level despite it slowly coming down. And with the inflation coming down, over the 2022, we know that the high inflation causes the central bank to increase their interest rate aggressively, hence causing the stock market to come down. However, with the inflation coming down, the rate hike cycle is likely to end soon. With just 1 or 2 more rate hikes to go, and with the US inflation at 3%, the goal is actually getting closer and closer to the Fed Reserve target. Fed Reserve means is the US Central Bank target of 2%. And while the employment data are still healthy. So the current situation is quite close to what the Fed goals are, which are stable prices and also maximum employment. And with the weaker inflation, it actually reduces the probability of further rate hike. So the market actually anticipates that the rate hike could stay within 2 cycles. So during the last Fed meetings, potentially the Fed chairman said that potentially Fed is considering another 2 more rounds of rate hike. However, the current Fed fund futures, the futures that track potential Federal Reserve rate, the Fed rate in the future, points to potentially 1 more rate hike only. This is because the inflation data is trending down and they are getting closer to what the Fed goals are, which is I mentioned just now, which is maximum employment and also stable prices. And actually the market is forward looking and the market actually anticipated this. Hence the US stock market has been rallying over the past month. And now the US stock market actually is in a new bull run, a new bull market. And currently for July month end, we have the tech companies announcing their earnings. And currently the tech stock are trading at a stretch level, which already rallied a lot. And those tech companies are announcing earnings these few weeks. So those already in position may need to watch out, as if let's say a certain tech company misses their earnings or misses their earnings forecast, it may cause a profit taking or sell off. However, the pullback will be an opportunity for you to go in if, let's say, you have identified the stock that you want to invest in. And over the past month, the tech stocks rally has been led by semiconductor, software, and communications industries, which related to themes like artificial intelligence, AI, or PC demand recovery in 2024 themes. So why PC demand recovery 2024? Because over the past 2020, the past 2 years or ago, during 2020, during pandemic, people are buying their PC. So in order for a normal consumer to upgrade their PC, usually how long do you think it takes for them to upgrade to a next generation product? You may type and answer me in the comment section. How is the usual upgrade cycles? How many years is the usual upgrade cycles for consumer in laptop and also smartphone markets? You may type and answer me in the comment section. And other than the tech sector, this round we also noticed that during the July month, other sectors also showing sign of recovery as well. Dow Jones actually break above their 1-year high. And also we noticed that those small cap and also emerging stock also shown sign of recovery. So with the Dow Jones Industrial Average also hitting break above the 1-year high, and also the emerging stocks also showing sign of recovery, do you think is a positive factor for the stock market, where we see almost every sector start to show some strength of recovery? You may answer me in the chat whether this is a very positive factors for the stock market or not. Okay, so over the past month, like I mentioned earlier, stock market has been rallied, tech stock rallied, S&P 500 also rallied as well. And we can see that the US stock market actually outperforming other markets, other stock markets. However, despite the US stock market currently in the bull market, it does not mean that we can buy or enter immediately to the market itself. Currently, it's trading at a stretch level, as I point here. You can see that the stock market has been rallied and currently trading at a stretch level. So as a trader or investor that already equipped with those knowledge, we will identify potential companies to invest or trade in and patiently wait for the setup based on our entry criteria. For example, pullback to a certain support level to enter the investment or trades that we already identified and planned. Also, as a trader or investor that want to have higher success rate or want to perform more consistent, we need to look at the asset or the market we plan to invest in. So to do that, we may need to gauge how is the past performance looks like as well. So from the chart here, we take the 10-year over the past 10 years performance and compare it against different market. So number one, we have the Nasdaq 100, which track the top 100 tech stocks in the US. And number two, we have the S&P 500, which track the top 500 companies, listed companies in the US. And then we compare it against the China market, Hang Seng market, which is Hong Kong market, and also KLCI, which is a local Malaysia market. So from here, we can see that over the past 10 years performance, where our Bursa KLCI is still at a negative 13.36% if let's say you just invest in the index, while the Nasdaq 100 and also the S&P 500 are having 475%, around 475% return, and the S&P 500 are giving almost 200% return. And China market is still sideways, while the KLCI, like I mentioned earlier, still downtrending and is still weak. It's likely may be due to the political instability, and also the political instability actually causes the weaker ringgit. And for now, based on the news I read around, not much foreign fund coming into the Malaysian market yet. So from here, we can see that the US market is more predictable and provide a more consistent return. So why invest in US? Because other than they are more predictable and provide a more consistent return, this is partly because also they having a more well-run company and also more profitable companies, and it's more regulated. It's a much more mature stock market compared to other countries. So what company that is well run in the United States that you are known of? You may answer me in the comment section. What company that is well run in the United States that you are known of? Yeah, I see some of the comments, Meta, Apple. These are all great companies. Okay, other than the factors that I mentioned earlier, like the stock market is already in a new bull run, the Fed are likely to stop their interest rate soon, maybe 1 or 2 more cycles to go, and the stock market charts actually showing you that they are on the uptrend. Other than that, there is also one more factors, which is money on the sidelines. So based on the money market fund assets, there are money market funds means that something like our FD, where the big players or the funds temporarily park their money at before they deploy it into like other investment. So it works like our FD, which is a fixed income kind of investment. So currently what we know of is there are record of 5.3 trillion US dollars in cash on the sidelines. So from the chart here, you can see that the money market fund asset since February 2023 were at 5.3 trillion, which is all-time high. And this is part of the reason why investors are stocking up on cash is to take advantage of the current high interest rate, because we know that currently US, the interest rate is around 5+%, around 5.25 or 5.5%, that region. So part of the reason why investors parking their position in cash is they still have some concern on the stock market, while they can park their cash and earning a risk-free interest rate, high interest rate. However, things may change. When the Fed start to have interest rate pause, or in future, maybe the interest rate start to U-turn or having a flat interest rate, this cash may move out from the money market fund to the stock market. Hence, this massive 5.3 trillion pound could be act as a fuel to the next bull market to drive the stock market further up. So with the do you think that with the cash 5.3 trillion cash rotating into the stock market in the future, do you think that the stock market will go higher or go lower? You may answer me in the comment section. Yes, potentially it could go higher with more cash going into the stock market. However, this one may need to monitor whether the Fed giving a more stable outlook in the future, where they will pause their interest rate. When the interest rate gets flat, most likely this cash will start to move out from the fixed asset like the money market to the stock market. So with all the factors we know about the month of July and a few factors I shared with you, so what to focus on second half of 2023? What are the opportunities and what are the risks out there? So let's start with the opportunities first. The opportunity still live, like what I shared during the June market update. The opportunity is still live with these key themes relating to the mega trends such as green energy, artificial intelligence, and so on. And also like 5G network upgrade or future generation network. And next also, the opportunity still live within the PC and also smartphone demand recovery themes in 2024. However, this one may need to monitor further, because we may need to monitor if those electronics or semiconductor provider able to clear their inventory in time. However, the opportunity lies on these two main themes, which is the mega trends like AI, green energy, next gen communications, and so on. And also those the recovery in the semiconductor section, especially relating to the PC and smartphone demand recovery. And next opportunities will be live with company with low debt, low exposure to bond, and strong cash flow. As we know now, we are in a high interest rate environment. US are having an interest rate of 5+%, around 5.5%. Hence, it's important to focus on company with low debt, low exposure to bonds, and those companies with strong cash flow that not rely much on debt or loans. And companies, also the number 3 opportunity will be company with less vulnerable to tightening of consumer spending. As you may heard about, people are talking about potentially a recession in year end of 2023. However, that could be unlikely because based on the Fed outlook, they do see some GDP expansion in Q4 2023, or potentially just a mild recession or a soft landing for the economy. However, we still focus on those companies that are less vulnerable to tightening of consumer spending. So we may want to focus on those tech companies with strong cash flow and also low debt. So, and they are also less vulnerable to tightening of consumer spending because they have more diversified income compared to those retail companies. However, it doesn't mean that retail companies we should avoid all. We should identify those good retail companies that temporarily have some setback due to this, and this could potentially be an opportunity as well because the stock market are forward-looking. And next will be the travel and also retail sector show some reversal. So we can see that the travel industry has been recovering as the global countries are actually opening up and moving out from the COVID lockdown. We can see that in situation in China no longer having lockdown, and Japan also opening up, and they have the travel industries are actually recovering, and also retail also shown some reversal. However, something to be cautious is this is under discretionary spending. So if we really go into recession at Q4 2023, people may cut their spending. And usually when people cut their spending, one of the budget they cut will be the travel budget or the discretionary spending. And also, if let's say you want to invest in travel related industry, you may trade the airlines, but airlines usually will not be a good investment because they have high debt, and company with high debt usually will not do well during a high interest rate environment. So something to watch out if you plan to invest in airlines company. And lastly, for the opportunities will be money on the sidelines. Like I shown earlier, we have 5.3 trillion cash on the sidelines that not yet go into the stock market. And this will be potentially come into the stock market when the rate hike cycle is over. And when they come into the stock market, it could potentially move the stock market to a new high level. So do identify those great companies that you plan to invest in and add them into your watch list for monitoring purpose. And after we go through the opportunities, let's take a look on the risk itself, risk factors itself. So if the interest rate prolong, if let's say the high interest rate environment prolong, it may impact affordability. And also it may create risk for the bond market and also housing market, as people need to service their housing loan in higher interest rate. Also, something to watch out for is geopolitical tension. However, this is quite becoming a norm nowadays. We can see that geopolitical tension between Russia and also Ukraine in the Europe, and also US, China, and Taiwan in the Asia region, and also the North American region. So we, as a trader or investor, we need to have our own appropriate risk management to mitigate this risk, as these are becoming norm nowadays for geopolitical tension. However, we can see that the opportunities actually outweigh the risk itself. And also lastly, it will be the slowing consumer spending. So over the month of May, we can see that the China economic data shown that there is slow recovery in China in terms of their economy. And this creates higher risk on the discretionary side, especially those companies that rely their growth or have higher dependency on China. Those sectors may be affected will be finance, energy sectors, or the retail industries. So from here, if we compare the two, we can see that the opportunities actually outweigh the risk. The potential upside actually is higher than the risk itself. However, with proper risk management, we can actually still invest and get good returns based on the opportunities we have. In fact, if there is a pullback or there are corrections in the upcoming months or upcoming quarter or towards end of this quarter or next quarter, it will be a good time for you to capitalize on the opportunities to take advantage of the pullback in the new bull market itself. However, having said that we are already in a bull market and we have plenty of opportunities, we also need to do it in a safe and also systematic way. So to do that, you may need to equip yourself with a systematic, versatile, and safe way to do so. You need to plan some time to practice and pick up the skill set while waiting for the opportunities. Because now the market at a stretch level, we also don't want to chase and end up we are entering at the high. So as a trader or investor, we have a systematic way to how to plan your trades or investment and patiently wait for the opportunities to come. And also, stock market is 6 to 9 months ahead of the economy. They are forward-looking. And now will be the best time for you to learn and also practice and capitalize on the continuation of the bull market. And since this is just a 20 minutes update and already slightly overrun, we would like to invite you to a free 3-hour webinar that covers a framework on how to approach the stock market in a systematic, versatile, and safe way. The next available webinar will be 9:30 a.m. this coming Saturday at 29 July. You may scan the QR code to register in the slide I shown here. While you are scanning and registering, I will open up for a short Q&A. Maybe I'll take 1 to 3 questions. You may type your questions in the comment section. Yeah, any questions, you may just type in the comment sections so we can attend to you. Anything regarding the recent stock market for month of July or this quarter. Okay, so I see an interesting question. Potentially, which sector you will be focusing on coming up? Okay, so for the upcoming sectors, I would say the opportunities, like I shared earlier, still in the tech sectors. So whenever there is a pullback, you may take the opportunity to enter the tech sector. Other than that, if let's say you are a trader where you want to capitalize the sector rotation, so-called sector rotation, where funds move between the sector, we can notice that the industrial sector, the financial sectors recently has been recovering as well. So if you, let's say you have trading knowledge, you can actually trade these sectors as well. And also the emerging stocks or the small caps or the mid cap and small cap also showing some sign of recovery as well. But these small cap and mid cap and also emerging are for more experienced traders. For investor, you can still focus on those tech companies with strong teams, strong cash position, and strong fundamentals for your long-term investment. Okay, then I see another question. What's your advice on FOMC? Should we stay away? So for July, FOMC is an important announcement. However, majority of the market already factor in the rate hike for month of July because of the previous press conference by the Fed chairman. However, the Fed conference for this coming FOMC will be important as well. So I would say not to stay away. If you already have position, you already in a profit, you may just hold on to your position just to avoid entering a new position or initiate a new position right before the FOMC itself. That's the usual way when we meet how to mitigate the risk, like having the market turn around after the FOMC. So if let's say you are a trader, avoid initiate an overnight position right before the FOMC. But for investor, usually you can just hold on to your position, which because investment we are for long term. So another question I see in the chat: how do we know all the money on the sideline will go into the stock market? So this is not sure, but we know that usually the money market funds are just temporary. Usually when big funds or big investor, when they are in cash position, they won't keep into cash. They will keep in the money market fund for the interest rate, overnight interest rate gain. So usually the big funds use this as a temporary instrument to park their funds when they are in huge cash position. So we may not 100% sure that most of these funds will go back into the stock market. However, there will still probability of certain amount of these funds will go into the stock market. And with around 5.3 trillions, even a portion of it go into the stock market also will cause the stock market to have some movements. So this is our take, that when the economic situation or the Fed outlook or the Fed rate high outlook is much more clearer or much more predictable, I think those funds that in cash position will start to invest their position either into stock market or bonds. So this depends on the fund manager itself. However, if let's say portion of this fund go back into the stock market, it will also high probability that it may push up the stock market as well. So this is our take on this, on the money market funds. It may not 100% all these funds go back into the stock market. However, portion of it, when the funds start to locate their cash position into the stock market, this will causing some probability that it will move the stock market, because the money market fund usually will be temporary parking area for those big funds with cash position. Okay, so with that, I think I have cleared all the questions in the comment section. So with that, that's coming towards the end of our market update. So thanks for joining, and we'll see you in the next market update next month. Okay, thank you. So if you are interested in the upcoming webinar or talk, then you can scan the QR code for registration. Thank you.